What happens when you mix mortgage advice, a spinning wheel, and two Joes? In today's episode, we throw out the script and decide to let the mortgage wheel of advice decide everything. From amortization to credit scores, rate buydowns to loan casting, whatever the wheel lands on, we break it down for you. So grab a cup of Joe and get ready for some no prep, no plan, just real unscripted mortgage talk. Stay tuned. Happy Wednesday, everyone, and welcome back to the Mojo Show. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
After a little bit of a hiatus from the show, we are back. In this week's episode, we thought about planning today's episode out, the script and everything, but we said, nah, forget about it. So instead, we put together a bunch of mortgage topics on a spinning wheel, and when we spin it, whatever it lands on, we're going to talk about it. What could go wrong?
A lot, but do we care?
Well, before we get to that, little coffee talk with the Joes this morning. Today is tax day, April 15th, tax day. I'd be curious, those that are tuning in, have you filed your taxes yet? Or are you waiting till today to actually file them? Are you a procrastinator? Joe, how about you?
You had to ask. So I just texted the wife this morning saying, hey, send me your W-2. So if that tells you I might have procrastinated a little bit, I have.
Okay.
I will tell you, I am not a big write off everything, try to get my taxes down. I usually I try to get a refund back every year. I try not to get in trouble with the IRS because that's not a fun feeling. So but I still wait. A lot of times I'll do an extension. Philip Wagner, I don't know if he's listening in. Extension has already been filed. So we can tell Philip is one of those, I've got too many things. He's got too many fishing lures that he's probably having to write off as a business expense. But Joe, what about you? You probably had yours done on February 1st.
For me, usually the first week or two, by the middle of February, usually I have them filed. I do. And this year, a little different. We had some snafus happen. I won't go into detail because you don't want to throw the laundry out there to everybody see. But it was actually 2 days ago I finally filed.
There you go. I did. Married life always puts us a little bit behind, so we can blame the wives because I know they're not listening to us right now. Go ahead. I do have a question for you about this, and you probably had to deal with this. So Hunter last year had his first time, job where he got a W-2.
Yep.
When I'm filing taxes, because I still claim him as a dependent, he doesn't have to file taxes separate, correct? It just goes in under Tina and I's.
So you can do it two different ways, at least. And please, any CPAs out there, please chime in on this because we would love some good advice on the best way to do it. I know everybody's situation is different, but for us, until Samantha went to college, I would claim her when I would claim her under my tax return. Yes, I used her W-2, right?
Okay.
And then once she went off to college and stuff, I help her do her taxes under her own, but I claim her as head of household as a dependent.
Okay.
So I've tried to look things up, and it appears, until she's 25, I can do that. So a little different with the young adults, if you will, in their taxes.
Well, I think, and I would love to hear some comments about it, but I think looking at it, he only had like $681 taken out of his pay.
Yeah.
And I'm like, okay, so what type of refund are you actually going to get with that little bit of money taken out and a summer job? So I think this year I'm still going to do it with him in mind and Tina's. But next year, if he gets a job working through college, because right now scholarship is his pay so far. So that's been pretty good helping out with the offset of that bill.
So JP just filed his a couple days ago, 5 days ago. Yeah, I agree. Stupid taxes. It seems like we're taxed on everything. I think we're even taxed on our taxes. Ridiculous. Joe, have you ever had, you were talking about, not getting in trouble with the IRS. Have you ever been audited before? I never have, but
knock on wood. No,
okay.
I have not been audited, but I will say when I was working at Chase, they did not take out taxes based on bonuses. So they just taxed you at what your salary was. And back then our salaries weren't very much. So the bonuses and everything else. Well, when I went to file taxes and all of a sudden I'm like, whoa, how do I owe $15?
Right.
When I'm claiming zero and everything else, and found out that it was because they were keeping us taxes pulled out as a tax bracket that way. I don't know what happened there. But that one, once that happened, I was like, nope. So I just don't want to mess with it. So I did. Tina and I think we usually do the standard since they've raised the deductible for the standard. I think we just go with that most of the time, which I know if you're a CPA, if Tyler's listening to this, he's probably just like cringing right now because I allow it to go that route. So, but we've had a lot of talk today. Guys, today's show, we really want some interactions. We're going to have some fun. I've kind of left this up to Joe because he's the one that always likes to prepare for our shows, gives me an outline I never stick to. So today we're changing it up, and I'm excited about today, but I'm also thinking today might be some of good bloopers for us too down the road.
I get a feeling it is, being that this is not scripted, but which I know you love a show that's not scripted.
That's right.
So
it makes it easier.
This is going to be, I'm sure, fun for you. So just to give everybody, here's what we're going to do. Bring it up on the screen here. I've put together this spinning wheel of mortgage topics, and we're just going to spin the wheel. What it lands on is what we're going to talk about. So let's give it a go here. Let's see how this works. Let's see if I can get it going right. I love the sound too. It's got the sound in there, right?
Oh, I can't hear the sound.
Oh, you can't hear the sound. Oh no.
Nope.
Oh, what's it going to land on? Oh, looks like PMI, private mortgage insurance. Good topic. Good topic, because this is something that a lot of people don't know about, right? Or never been explained to them as far as private mortgage insurance. And I know, Joe, you could probably elaborate a little bit better with the numbers, but with FHA, it's a set percentage.
Yeah.
Right?
So
0.55, am I correct?
0.55 is the factor. Yeah. With FHA, the nice thing about it is that, you're looking at that when your credit's not probably in the 720 and higher range. You're looking at an FHA loan a lot of times if you're not putting 20% down. And since they lowered that factor, was about 3 years ago, they lowered it from 0.85 down to 0.55. It made it more competitive against private mortgage insurance companies, where like conventionals, it's based on risk. So a lot of times, you'd look at FHA and, even with the higher interest rate on conventional with the private mortgage insurance, sometimes it made more sense when you had that 700 FICO score. But when they made that change, anytime under 720, the private mortgage insurance, if you're only putting 5% down or 3% down and you don't qualify for like an affordable home ready, home possible loan, the MI is a little bit higher than what FHA is if you're under that 720, in my opinion. Yeah. So I like private mortgage insurance. And what people don't understand to me is it is tax deductible. So it's put into your interest and everything else that you're writing off against your income. And we're talking about tax day, right? So perfect timing on this is that private mortgage insurance now, you can write that off. And with some people, if you're putting down 10% or 15%, you're
Mhm.
talking maybe 25, 40, 50 bucks,
$50. Yeah.
you
Yeah.
know?
It's really not that expensive, right?
Yeah. So Joe, what have you seen when it comes to the conventional on the PMI, based on credit and based on debt to income ratios? What do you see?
And I think that's something that people need to understand about PMI, right? That it's not like FHA, just a flat number percentage or anything. It's going to be based upon different factors. Yes, your credit score will put you into different buckets. And correct me if I'm wrong, I think it's every 20 points on your credit. So from 660 to 680 to 680 to 700, 700, 720, puts you in different buckets of pricing for the PMI. And then I think it's your LTV, right? Your loan to
Yep.
value puts you in different buckets as well. So, depending upon those two factors is really going to decide how much your PMI. Now, PMI though, Joe and I work with over 20 different lenders. Each lender is going to have different pricing on that PMI using different private mortgage companies, right? Private mortgage insurance companies. So, one company could be at $84 a month. Another company could be at $62 a month, right? So it's great to be able to kind of shop that around along with shopping around the mortgage with different lenders.
Yeah. And so what I found out on that too, Joe, is with our investors, you can ask them to look at a different private mortgage insurance company. Usually they give you the one that they use the most because it's the better pricing.
Right.
But sometimes I've had them look into others because on conventional, you can shop around for the private mortgage insurance. There's not a ton of things out there that you can shop for when it comes to this. And most of the time, like Joe said, the investors have the ones that they utilize. But, we are looking for the ones out there that have the better, payment for you on that private mortgage insurance. The nice thing about it too, though, is that the only reason that we went away from having to have 20% down back when our parents and our grandparents were buying homes when we were little is because of these types of insurances that came in to where people could afford to buy a house with 5% down, 10% down, and not have to wait until they had the full 20. Right. So there's a lot of benefits to it, not just negatives. Yep. So I think people need to be more educated on it and get with a good professional that can do that. But we have plenty of other things to talk about today, and I could keep going on about private mortgage insurance, to tell you the truth.
We could probably do a whole show on that one. And before I spin the wheel, folks, if even though we've got, I think I put like a dozen different topics on here, if there's a topic that you would like to see on here, because actually Joe and I would, I think we should do this episode, the spinning wheel of mortgage topics, like once a quarter at least. Right. So if there's topics that you guys want to see on here that we're not, that aren't on the wheel, drop a comment. We would love to just add it to the wheel as for the next time. Let's take another spin, Joe, and see what we land on this time.
If it lands on PMI again, we have problems.
We do, and we do have a problem. Yep, we've got a problem here. We do. Yes.
Hide the choice.
Let's do that. Let's hide that one, and let's give another spin here and see what we land on. What's it going to be this time?
Funny thing is that was 3 times in a row on PMI.
Yeah, amazingly. What are we going to get? Closing costs explained? Yes, closing costs explained. That was a tough one to say on a Wednesday morning. I think this is one that not enough people understand. Right? Because majority of the time, I know, Joe, you and we cover this in detail with our clients when we get them pre-approved and everything. And again, when they go under contract. But a lot of loan officers out there do not explain closing costs. It's just, here's 10, 12, 15 grand, whatever it is in costs. I mean, I don't know about you, but if somebody gave me a bill for 12 grand, I want to know what it's being spent on,
Yeah, it's in our industry, a lot of times you touch on the things the client tells you, right? How much cash do you want out of pocket? Oh, 25,000. So we structure a file. What payment do you want? Oh, okay, 2,500, right? So when we structure those, professionals in our industry will go through and explain the details. Salespeople in our industry that just want to, turn and burn, they're going to give you, hey, I got your payment where you want to. Hey, I got your cash where you want to, and they're going to move on.
Right.
And I hate that type of mentality. I'm not saying it's not a practice that people use. I like to explain it. And right now with our change, that I've been really busy going through disclosures and putting the fees in there. And knowing the breakdown of the sections and what section goes with what is good. Like your section A, which is your origination fees, that's more your discount points. And then if you're a correspondent lender, that's where a lot of those fees would be for your processing, your underwriting, things like that. Section B are those ones that you can't shop for that are third parties. So your credit reports and things like that. And like for us, contract processing, because now we're processing for LOs. So, that's knowing what are those and why are they third parties? Because I think sometimes people explain, oh, these are just third party fees. Well, if you're in retail, they say that in section A, but that's not true third parties. It's only section B is. So explaining that. And then section C is your title. Those are the big ones. Those are your true closing cost, in my opinion, then your recording fee. After that is your prepaids. That's your escrow setup. That's other things that truly aren't closing costs, but they are associated with your loan.
Absolutely. Good outline on that. I'm not even going to add anything more to it. I will say though, I will just real quick. If you're looking to purchase a home and your loan officer is not going over in detail with you the closing costs, fire them. Fire them and call the Joes, and we'll help explain things to you because look, none of us want surprises. Buying a home is stressful enough. Refinancing is stressful enough. You don't need to be in the dark about these things. So if your loan officer is not explaining them to you, fire them and call the Joes.
All
right.
So I just helped a client, past client. I helped their son buy a house.
Yeah.
And it was so nice getting the phone call from the dad, just saying thank you. And on the way that I did it, explained everything, because his son was the first time, but they've bought multiple homes. So that made me feel really good that I treated it the same way I do all my clients, but to get that extra phone call, just, they really appreciated me going through it. So I like that.
Good stuff. All right, let's spin the wheel. Feel like we're on the Wheel of Fortune here. Where's Vanna? We need to. Oh, we got seller concessions. Nice.
We could do a whole episode on this one for sure.
Yeah. Definitely we could. Seller concessions, it can be, and granted, we've been seeing a little bit more seller concessions lately, with the way the housing market is. But seller concessions, these are great because you, the buyer, can use it for several different things. You're not restricted to just, you can use it for, well, a matter of fact, I was going over it with a client yesterday as far as different options they could use it for. They could, we looked at a 2-1 buy down to use the seller concessions for. We were looking at using it to permanently buy down his interest rate. Right. So there's a lot of different things.
Joe, what is permanently buy down an interest rate? What are you talking about there so people understand?
And actually, we've got both of those subjects on the wheel.
Here? Okay, so I'll leave that alone.
Yep. We've got both those subjects on there. So
the one thing that people need to understand on seller concessions is the type of loan and the down payment does matter for what is allowed. Seller concessions also, none of that can go towards your actual down payment.
Right.
So, people that want to try to buy a house, well, if you're going FHA, that 3.5% down, you can't have any seller concessions going towards that part of it. So, I don't know, Joe, if I'm sharing too much, but conventional, it depends on your down payment. If you're doing 3%, 5%, 10%, 15, or 20.
Yep.
It tells you what you can get on seller concessions, and actually on conventional, it's called interested party concessions. You have to be a max on those. So there's a bunch of details in there, but I love that you can make an offer, a strong offer. Don't try to lowball and ask, because that still in this market doesn't work. But a strong offer, you could get the seller to pay all of your closing costs for you. Yeah, you're paying for it in the price, but the price of that house and the payment is not a huge difference, but 10 grand out of your pocket's a big difference.
Yep, absolutely. And seller concessions, you kind of alluded to this as far as conventional loans, how much you can, I mean, standard, right? The 3% down, if you're doing, right, you get, you can go 3%. I think it's up to 5% down, right? No,
Yeah,
it's 10%.
up to 5% down,
5% down, you can do
3%.
3%, up to 3%. Seller concessions. FHA, you can go up to 6%. VA, 4%, but you can go above that. Right. So
I was wondering if you had that on the wheel, because there's some nice things. If you're a veteran or active military and you qualify for the VA loan, you can actually have seller concessions of that 4%, paying off your credit card debt, paying down debt. A lot of things in there that can be utilized. It's so nice to be able to do that. So if you're making a strong offer and you want to get out of debt, you could get into that house with almost no money out of your pocket and have your debts paid down or off. So it's a very nice way of doing a loan.
Before we spin the wheel, evidently JP wants us to land on credit score hacks. So we'll have to see what the wheel does. Maybe it will. Maybe next time, let's check and see. What are we going to get this time? Oh, went past credit score hacks. Sorry about that. Oh, DTI, debt to income ratio. Nice. Debt to income ratio. This is important. This is very important in qualifying for a loan. A lot of people think that qualifying for a loan is based on your credit score. There are so many different factors in qualifying for a loan, and this is one of them. Your debt to income ratio, right? Where we take your debts, I'm talking about like car loans, student loans, credit card. We're not talking about your, cell phone bill and that. We're talking about actual debts, liabilities, right? And when we do, we're not looking at the balance. I don't care if it's 15 grand, 4,000, doesn't matter. What we're looking at is the monthly payment. So the monthly payment of all of those, plus the monthly payment of your new mortgage that we're estimating, divide that into your qualifying income, right? And that'll give us the ratio that we need. Now there's different ratios for different loans, right, Joe?
Yep. There's different ones for FHA and conventional. And what you guys need to understand is whenever somebody says, oh, your max debt to income ratio is 50, well, that doesn't mean you're actually going to get qualified if it's under 50. Because of, like Joe says, there's a bunch of different factors that are taken into account. So just because your debt to income ratio is under 50, there's other things that could still cause us not to be able to get you approved. And then FHA, you can go a little higher, but again, I think you can go, 56.99 on the back end.
If it'll approve it, if AUS or automated underwriting system approves it, yes.
So Joe, I'm going to ask the question, why would you allow a client to go into a very high back end debt to income ratio to buy a house? What are some of the things that you look at when you're like talking to them and being like, okay, yeah, we can get you qualified, but you have a 55% back end debt to income ratio. Do you have those discussions with your clients?
I have the discussion with the clients in regards to the monthly mortgage payment. Okay. When I'm going through, because once I get somebody pre-approved, I do a live video call with them, share my screen, and I'm going through all the numbers. And very importantly, one of the first things we go over is the estimated monthly payment, the principal, interest, homeowners insurance, property taxes, PMI if it's there, and then what the bottom line number is. And I always ask the question, how does that fit into your budget?
Yep.
Because even though the AUS or automated underwriting system qualifies them, that doesn't mean that it fits into what their budget is or what their goal is, right? So those are the conversations I have, because before we go any further, I need to know, do we need to make adjustments? Do we need to bring the purchase price down? Instead of 350, do we need to bring it down to 300 so it fits better into their budget?
Yeah.
Right? Because I mean, I've got a client right now, either this week or next week, they're expecting their baby to be born, right? So, I mean, there's all of us parents know that is an expense.
Yep.
Let's just say, right? So, you want to be able to make it to where they're not going to be eating ramen noodles every night.
Yeah. So one of the things that I also look at, not just the monthly payment, is there other income that I'm not able to use? So when I'm looking at an FHA loan, or if I'm looking at a VA loan and I have that higher debt to income ratio, if they're married and maybe I'm not using the spouse's income, maybe their credit's not there, then that's when I'll stretch a little bit more on the debt to income ratio on a pre-approval, but I'm still taking into account that information. So I just had a client, was it Friday? I was going through a pre-approval. They wanted this house. I wanted to get it for them, but at the end of the day, I just was like, I'm putting you in a situation that I don't know if it's the right thing for you. And I just had a different conversation with them. So instead of them buying this house, they're decided to use the equity in their home and consolidate their debt first. Okay. And that way he doesn't have to worry about that overtime pay or that extra commission pay or extra other pay, to live life. And, I'm turning 50 this year. That's a big stress reliever of, I don't have to worry about that, because I'm not living on, if I don't make this, I can't make that payment anymore, because I was in that situation. And a lot of people do get into that situation. So having a professional that'll have those conversations with you is important to me.
I didn't realize that was the direction that you were going with that question. I apologize, but I think we got time for just one more spin of the wheel. Let's see, before we wrap things up, let's see you know what? I didn't hide that topic. I hope it doesn't land on that again.
It didn't.
One of our favorites. We did this about a month or two ago, amortization. This was a great episode, folks. Actually, we ended up doing 2 episodes on this. If you didn't get to see it, go to our YouTube channel, right? The Mojo Show Real Estate Podcast, and check them out, because I think that was like episode 81 maybe, or episode 80. Check those out. A lot of great information on those. Amortization. Give us a good, I don't want to say hack, but trick or tip on amortization.
Okay. So if you're in this market, you're buying a house, you're worried about that interest rate's high, whatever. A good hack here is to take one full PI payment, your principal and interest payment, divide it by 12, and add that to your payment towards principal every month. Okay. If you do that, you'll pay your mortgage off about 7 to 8 years. When we did that show, Joe, about 7 to 8 years less time. Now you're not going to keep it for 30 years, but it's actually taking away principal balance that your interest is going up against every month. So the more you pay towards that principal, you can beat that interest rate and get more equity in your home. So when you go to sell it or refinance it, you're at a lower loan to value.
Yes, absolutely agree. Because when you look at the amortize, and when you purchase a home, they give you these documents. They're probably about 20 pages showing every payment every month and how the principal is coming down very little, right? And as you and I discovered when we did the show, it was like the first 20 years, I think, on a 30-year mortgage. About 20 years later is when it finally flips, of more of your mortgage payments going towards the principal instead of the interest. So the sooner you pay that down, the less interest over the life of the loan that you're paying. And that's the goal of it. I mean, you could save in doing the hack that you had mentioned. I mean, you could, depend upon your loan, you could save 70, 80, maybe 100,000, over the life of the loan just by doing that hack, which is awesome.
Yeah. And I mean, when you refinance, if you have a 7.25% rate today, and let's say, hopefully in 2027, well, we can get you into the fives. Well, if you keep making that 7% payment and you just apply that extra towards principal, that's where you'll see a huge difference in that hack too. So that's just another little tidbit to take away.
Well, I think this was a great show. I love this. I think we need to do this a couple more times, at least once a quarter, to go through this, because great information. Of course, every time it's going to probably land on something different, but we hope all of you had fun with this as well with this episode. I think definitely one we need to do often. If you'd like information on any of these subjects that we hit on or some that we weren't able to get to, reach out to the Joes. The email address below there. Reach out to us. Be glad to have a talk and just, kind of an educational conversation on things. Next week, folks, we are going to have on a special guest, Keaton from Lone Star Home Inspection. We've been wanting to do this for a while, Joe, right? To be able to have a home inspector on to discuss what you need to know about home inspections, what to expect. So tune in at our usual time, Wednesday, 9 a.m. next week. Even better still, be sure to subscribe to our YouTube channel so that you don't miss an episode, as well. Be able to go back and look at some of the other past episodes for educational information and purchasing or just owning a home, which you can always do that at the Mojo Show Real Estate Podcast on our YouTube channel. And of course, while you're there, when you hit the subscribe button, because we are on a mission to get to 1,000 subscribers, and every like, share, and comment that you guys give, it reaches more homeowners like yourselves. So before we close things out, Joe, any last words or nuggets of advice for our listeners?
Joe, I like this show. I like going off script. So thank you very much for putting this one together.
Absolutely. And thanks, Diane, for the comment. Appreciate it very much. Well, I'm Joe Mortgage, and that handsome guy with the beard is Cup of Joe Mortgage, and we'll see you next week.